I hope everyone is doing well out there. This is your May market review. The reason that I put these videos together each month is to give my clients the straightforward information with no media spin, political angles, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this is to just give my clients the information about what's going on in the stock market, the economy, and ultimately how that affects their money. The S&P 500 as of June the 9th here today is up about 11% year to date. So it's done really well over the last month. In May, we had a nice uptick in the market as the debt ceiling issue kind of got itself resolved later in the month. So I rebalanced IRA portfolios here a little over a week ago. So if you haven't noticed or gotten any sort of confirmation statement in the mail, for those of you that get confirmation statements in the mail, one of the newest things I've added to the portfolio is a home builders fund that invests in companies that have to do with building houses or repairing houses. So companies like PulteGroup, Lennar, Home Depot, Lowe's, or just to name a few, some of the companies that are held within this fund. Specifically, why I did this was because it's been an area that I had wanted to add to within the portfolio for a while now, and I just got the opportunity here about a week and a half ago when it was very oversold, and I took money that was sitting in a 5% treasury bill fund that we have within the portfolio. I cut a percentage of that back and added to this home builders fund. So since then it's up about 10%, so it's been so far a great addition. I think that it's a relatively small portion of the portfolio, so don't get too excited. It's about like 3% of portfolios overall, 3 to 5%, depending on how aggressive or conservative your portfolio is. But I think that it is an area that will do really well over time because of where the housing market is at big picture. So the Federal Reserve is likely to, if they do raise interest rates this month, it'll be 0.25%. They're not likely to keep raising interest rates at the pace that they definitely did over the last year. So if we're looking at this from a housing standpoint, there should be more demand that comes back into the housing sector because people over the last year have put buying homes or building homes on pause for a little bit. So generally speaking, when interest rates go higher, that's not a great thing for a home building company like a Lennar, PulteGroup that rely on people wanting to buy those houses. And typically when interest rates go up, less people want to buy because it now costs more money for them to buy a house. So that was the newest addition to the portfolio, and just a small rebalance I wanted to update everybody on, especially because I know a majority of my clients, you guys watching this, that have IRAs with me. That's a fund that is in all of your IRAs. So just so you know that. A couple charts that I have here this month. I actually got a few charts, but really two main topics I wanted to talk about. So the first chart that I have is going over the big news of last month, which was the debt ceiling and the potential of Congress and Washington really just not getting it passed and how close it actually came. So this is a chart as of June 2nd showing the U.S. Treasury General Account cash balance, which was about $23 billion, which, being that it's the U.S. government, is actually a really small amount of money. You can just see just from the beginning of May, we went from about $1 trillion to where we were as of June the 2nd at $23 billion. That's a pretty big drop in a month's time frame, but that's how much money the government spends every single month. So, this chart's going back over the last year, but still a lot of money over the last year. So, good news is though, obviously, that they passed that. So now they can issue more bonds to make sure that their debt is being paid for and continue that cycle. So that was the big news that happened here within the last few weeks, which has just caused a continued rally within the markets. The next thing that'll come up will be next week on June the 14th. That will be not only my birthday, but is the Fed announcement, and they're going to decide whether they're going to raise interest rates, and then they'll speak on exactly what their outlook is moving forward in more cryptic talk like they typically do. So next charts that I have go into talking more about the market move that we've had this year. So the top 8 stocks that represent this chart here are the percentage of the overall market. The top 8 stocks have really moved the overall market this year, which they've done this before, and it's been a continued pattern over time. Last year, a lot of these stocks were down a lot. This year, it's reversed course to a large degree, and it likely will keep moving forward, I would expect, to some level at least. So these top 8 stocks listed at the bottom there: Alphabet, which is the parent company for Google, YouTube, to just name a couple big ones that you may recognize, Amazon, Apple, Meta, which is the parent company for Facebook, Instagram, WhatsApp, Microsoft, and Netflix, Nvidia, and Tesla. Those are the top 8 companies that make up the S&P 500. So out of the 500 plus companies that are in the S&P 500, these 8 companies make up right now 30% of the market. So one of the reasons I thought this chart was interesting and worthwhile going over with you all out there is that it's a chart that shows how dominant those companies are, but it also depicts that there's a lot more companies that haven't done well this year that hopefully will start catching up. So there's another chart that I have here showing the equal weight versus the S&P 500 performance. So the equal weight is if we were to take into account that Apple and Microsoft get the same weighting as the smallest stock within the S&P 500. So where these stocks make up the 30%, they would be 1/500th of a percent, or whatever that mathematically adds up to. So that way Apple or Microsoft doesn't move the index the way that it actually does. That's what an equal weight index is. So the equal weighted index this year has outpaced the S&P 500, which is market weighted, meaning that the larger companies influence a lot more, like that last chart I was showing you with those top 30 or those top 8 companies representing 30% of the market. These are all equal weighted, and it's the largest percentage difference that the S&P 500 has had over the equal weight going back through 1990. It's up over 10% or 10% difference as far as the year-to-date rate of return goes. That's, I think, very important, because all the time in finance, there's always, and especially investments and investing or finance as a whole, there's always this repeating thing that happens called reversion to a mean, where one time at a certain point something might overshoot in one direction and then it reverts back to its mean or its average that it typically is at. So this, I would not be surprised if the rest of the stock market, those other 590 stocks or 490 stocks out there, those will likely, I will think, catch up to what the top 8 companies have done. So that's, something I think that was very interesting. There's another chart here that shows that equal weighted difference, just in a different line graph form, going back through the beginning of 2023, showing the equal weighted performance was moving in lockstep, which typically it does move pretty closely to what the overall market performance is. But in the last 3-4 months since March, very, very dramatic difference. One of the reasons that I look at this chart and I say that there's some major difference is actually because the divergence started when there was all the regional banking crisis with the 2 regional banks that ended up failing in March. That was a big deal at that point in time, and that's actually when the divergence started. So if financial companies and banks and regional banks start actually performing better and rebounding a lot from the losses that they've had, which is one of the reasons that I still have the regional banking fund held within IRA portfolios still, is because I believe that it will not just start, because it's already started rebounding, but continually keep rebounding back. Maybe not to the same levels that it was at beforehand, but close to it. So which, because I've rebalanced a couple times and added more money to that specific position, if it just gets back even halfway to where it was, we'll be break even on that position after a really steep loss within that position in April or in March and April here. So those are the charts that I have for you all this month. So I appreciate, I got to see a lot of you in person here last month up in Pennsylvania. I'm doing more reviews here with people this month via Zoom. If any of you have any questions, don't hesitate, call, text, email. If you have, if you'd like to do a review and we haven't done a review in a while, reach out to me. I'd be more than happy to either catch up with you over the phone or do a Zoom share screen type of meeting in that way. If you have friends, family members, people you think would be interested in having a conversation with me about their investments, please don't hesitate to get them in touch with me. I'd be more than happy to have a conversation with them. I appreciate you all, though, for taking the time to check me out. Until next time.